All right, I guess I should see how my stock portfolio did this week. Oh my gosh, that's a lot of red. Alright guys, so here we are in my M1 Finance portfolio, and before I get started, I want to say thank you to whoever signed up for M1 Finance using my referral link. Whenever you all do that, you get $10 free to invest, and I get $10 free to invest, and it really does help out this channel. It helps me devote more time to my videos. So I sincerely appreciate it, and if any of you all want to sign up for M1 Finance, the link is in the description. I really do think M1 Finance is a great platform for both beginner and experienced investors, and I really wouldn't be promoting it if I wasn't a big fan of it myself. So with that being said, we'll go into the performance of my M1 Finance portfolio. As I've stated before, this portfolio is solely focused on dividends. It's all about trying to grow the dividend payments I receive over time. So we'll go ahead and look at how it has performed over this past trading day, which was this past Friday. So this past trading day, the portfolio's value dropped 1.4%. Over the past week, I'm actually up 1.8%. Over the past month, I've gotten slaughtered. I'm down 10.2%. Over this past quarter, still doing pretty bad, down 9.1%. And all time, which is going to be the same return as this year since I started this portfolio back in July of 2019, I am down 9.2%. So this was a pretty rough week in the stock market. It was kind of crazy because we had that day on Monday where the Dow actually had the largest point gain in history. I think a lot of people thought that maybe the market was about to turn around, but nope. The rest of the week was pretty rough. So we'll go ahead and look at some of my activity over this past week or so. So as you can see, on the 2nd, I received a 7-cent dividend from Aflac. On March 2nd, I received a 6-cent dividend from W.W. Grainger. On the 2nd, I also received a 7-cent dividend from Intel. On the 3rd, I received a 2-cent dividend from Visa. On the 4th, I received 5 cents from American Waterworks. I also received 10 cents from Archer Daniels Midland on March 5th. I received 8 cents from Boeing on March 6th. Also received 12 cents from Pfizer on March 6th. And as you can see, on March 6th, I did decide to deposit $20 more. So I did dial back the investing a little bit. 2 weeks ago, I think I added $100. And then the week before that, I think I added another $100, which is more than usual for me. I thought I saw a buying opportunity. I thought I saw an opportunity to buy the dip. So I thought I'd put in some more money, see if I couldn't increase the dividends I'd be receiving a little bit faster. Now the market did go down a little bit further, which I'm not too upset about. I am investing for the long term, so 2 or 3% here or there, not a big deal. I will show you though, if we go and we look at my investment pie that I am using, as you can see here, the dividend yield is at 3.74%. At one time, this dividend yield was at 3.1 or 3.2%. And I think more recently, I remember it at 3.3%. But the reason this happened is as the value of my investments went down and their dividend payments stayed the same, the dividend yield came up. So now might not be a bad time for me to invest some more money because I could take advantage of that higher dividend yield. Now, the risk I run by doing that is two things. First of all, the companies that I own and that I buy could decrease further in value, meaning I lose money from what I invested. The other risk that I run is dividends aren't guaranteed, and some of the companies that I invest in could potentially cut their dividends. So in a time like this where the market's dropped, I think I have an opportunity to buy some shares at a lower price and increase this dividend yield, but I also have to be conscious of the fact that maybe these companies are dropping in value because they expect to earn less money and because of that, they may have to cut their dividend yield. So when I'm doing this, I really have to weigh the pros and cons of adding money in, especially when I think that there's a possibility that these stocks could go down because of greater coronavirus fears, solely because they're overvalued. You all kind of get the idea. So with dividend investing, I want you all to keep that in mind. Usually with a higher yield, there is more risk. So just think about that. Keep that in mind when you are picking out your dividend stocks. So with that, I think I want to show you all my best and worst performers all time. We'll see how that has changed. So I'm going to sort by total gain. So surprise, surprise, Apple is still my best returning stock. They were on a tear this past year. After that is Crown Castle. I don't think I've seen them up here, but I suppose they've done pretty well this past year as well. And then American Waterworks. Now, I am kind of surprised to see this one too, but I guess it's done so well because it is a utility stock. Utility stocks tend to do pretty well during a recession or during any time there is a lot of fear going on in the market because that's kind of your basic necessities. Everybody needs water. Everybody more or less needs gas and electricity. So that's kind of interesting. Now let's go look at my worst performers. So Interplus has been horrible for me, down 77%. I may have to go look at this one a little bit more, see why it's down as far as it is. It may be that they cut their dividend. I'm not entirely sure. Anheuser-Busch has not done very well for me, and ExxonMobil has not done well. I still do like ExxonMobil. I think the reason they're down so far is oil prices have been pretty low over the past few years, so they haven't been able to make as much money off of selling their oil. And in addition to that, their demand for oil is going to be lower here in the future because a lot of companies in China, when they had to close their factories, they obviously ran their machinery less, which means they needed less oil. So I think that's part of why ExxonMobil has been hurting lately. I don't know if I think they're going to bounce back or not. One thing I want to research a little bit more on ExxonMobil is I want to see how big of a dependence they have on just oil and gas and kind of what their other businesses are. If they have any stake in the renewable energy industry. If you look at their commercials, they always try to brand themselves as a renewable energy company, or at least a company, at least a overall energy company. They kind of stay away from that gas and oil label. They don't want to be labeled as a big oil company. So I'm going to have to do some more research on ExxonMobil, and if I like what I see, I may pick up some more shares. So with that, I think we'll go ahead and jump into my Robinhood portfolio. So here we go. All right, guys, so here we are in my Robinhood portfolio, and I'll jump right into showing you all how this portfolio has performed recently. So this past trading day, I was down about 1.2%. Over the past week, actually up about 0.3%, not too bad. Over the past month, still not doing too great, down about 8.7%. Past 3 months, down about 4%. Over the past year, I'm only up 6.22%. And all time, I am up 12%. So you all can see here on this 1 year chart, at one point I was up around 17%, and now I'm only up 6% over this past year. And if we look at the all time, at one point I was up about 23, almost 23.5%. So this portfolio has been hurting lately. I think everybody's portfolio has been hurting lately. But I'm hoping because I own some dividend stocks, some value stocks, that my portfolio won't do too bad, even if the fears of the coronavirus get worse. So with that, we'll kind of look at some of the stocks in my portfolio. As you can see here, I have been trading options just a little bit lately. I talk about this pretty much every week. I trade very low risk, low reward positions, mostly just as a way for me to learn how they work, learn how to trade them effectively. I think it'll be a good tool for me to be able to use in the future. But as I always caution you on this channel, please stay away from options. If you don't fully understand them, they can get you into a lot of trouble if you don't know what you're doing. So one of these stocks that I really have been wanting to talk about is Carnival Cruise Lines. So here's Carnival stock, and as you can see, they have dropped big time. So at one point they were at around $51, and then I think a couple of years ago they were actually got up to almost $70, and now they're at $27. They're trading at a PE ratio of 6.3. To put that into context, the Standard & Poor's 500 is at around 20 right now, I believe. So this is kind of crazy how low this PE ratio is. And not only that, their dividend yield has jumped up to almost 7.5% because the stock has dropped so much in value. So why am I so interested in Carnival right now? Well, I think they have gotten hit the hardest by all the fears involved with the coronavirus. Because people are afraid of the coronavirus, because people are afraid of coming in contact to other people who might have the coronavirus, less people are going on cruises, and that is why this stock has dropped so much. And usually hospitality stocks like Carnival are usually hit the hardest by some sort of epidemic like we are facing with the coronavirus. Now, why do I think that Carnival might actually be a good buy? Well, I think they are a pretty solid company. As you can see here, they do have, positive earnings. They do have some variation in how much they earn. Certain seasons they earn more than others because more people take vacations. There are a lot of fluctuations in how much they earn, but overall, I think it might be a buy, and I'm definitely going to keep my eye on it because I think this coronavirus weakness is short term, and if we find a cure or if people find out that this coronavirus isn't as bad as everybody thinks, I think Carnival will go right back up. I could see it rising back up to probably the $40 range, and then once they release their earnings for this past quarter, I think it has the potential to go higher if maybe the earnings aren't as bad as people thought they might be. But there are a lot of travel and hospitality stocks that have done pretty poorly recently. American Airlines, it's down 45% in the past month. Now, just because these stocks have dropped so low as they have does not mean they're necessarily good buying opportunities. And one of the most difficult things about buying a stock like this, a stock that you might consider to be a value stock, is that, it's dropped 45% already, but it may continue to drop. So it's really hard to pick a point to buy into. If you really believe in American Airlines as a company or Carnival Cruise Lines as a company, it might not hurt to pick up some shares, especially if you think they are going to turn around soon. So the way I like to do that when I buy a stock that has been dropping like this, I'll pull up Carnival. So something I would like to do is see Carnival's currently $27. So I think that there is a pretty good potential for Carnival to continue to drop. So if I thought Carnival was fairly priced here, what I might try to do is, let's say I wanted to build a position of 20 shares. So what I might do is I might go ahead and buy 5 shares now, and then see how Carnival does. If it drops another 5%, maybe I'd pick up another 5 shares. If it dropped another 5%, maybe I'd pick up another 5 shares, and so on. So the way that I recommend building a position in a stock like this that has just been dropping pretty much off the face of the earth is do it slowly. Don't rush into it. I don't think unless somebody comes out tomorrow and says, "Oh yeah, we found a cure for the coronavirus." I don't think this is going to drop. This is going to jump like 10%. And even if it does, you're still looking at a price of around $30, which is way below the $50 it was trading at earlier. So just be patient. I know it looks like a good deal right now, at least to me, but this is something I have to remind myself is there's no need to go ahead and jump into a huge position and then potentially lose even more money if the stock market was to drop. So I guess something else I wanted to talk about is my Treasury ETF. Back in August when I bought this, for a while I was like, oh, why did I do this? Why did I buy this? The stock market's doing great. Well, now here when I'm up almost $40 on it, I'm pretty happy that I decided to buy it. It's never a bad idea to hedge your portfolio a little bit. It's never a bad idea to put some money in safer investments like bonds. You just have to know your own risk tolerance. That will help you decide how much of your portfolio to allocate to bonds and safer investments. Something else I found that I really have been wanting to talk about is this SHV. It's a bond ETF, and it has a 2.1% dividend yield, and that's just from the coupon payments from the bonds that it owns. So the nice thing about a bond ETF like this, if you see this chart, it looks super spiky, but really it has stayed between $110 and about 40 cents and about $110.85 over the past year. And, even over the past 5 years, it has only gone up 0.53% in value. So why am I telling you this? Well, a bond ETF like this one has a very low chance of dropping significantly in value. Like I said, it's only gone up 0.53% in the past 5 years. This is because this ETF owns a bunch of short-term bonds. So even if the interest rates drop or increase, this bond ETF does not have a whole lot of exposure to that because the bonds that they own expire soon. So if there is a change in interest rates, they can just wait for those bonds to expire in the next couple months and then buy some new bonds at the better interest rate. So the advantage of a bond ETF like this is it is kind of like it's not quite like putting your money in a savings account where your money is insured by the FDIC, but it is a pretty safe place to put your money in, and it does get a 2.1% interest rate. I know the savings account that I have my money in right now pays something like 0.15%, which is ridiculously low. So I've been kind of thinking about putting some of my money into this short-term Treasury bond ETF, just so I can take advantage of that higher interest rate with really not too much greater of risk. Outside of that, I don't think I have too much else to talk about today. You all can see these little pluses by some of the stocks and ETFs I own. That just means I've received a dividend from these companies and they will be reinvested at the next trading day. I received a dividend from Visa, which was reinvested. Visa pays a pretty low dividend right now, as it is more of a growth stock. So I received 90 cents of dividends, and thanks to that, I received 0.004728 shares. So not too much, but hey, something is better than nothing. I think that will continue to grow over time. I think Visa is going to raise their dividend payments over time. It seems like they make a pretty considerable amount of cash right now. Their earnings are like around the $1.40 per share range per quarter. So they can definitely sustain their 30-cent dividend payment that they are paying right now. And I think there's a lot of room for them to grow that payment in the future. So Visa is kind of the definition of a dividend growth stock. Not a huge yield right now. I think they yield like 0.8% or something, but that yield will likely increase quite a bit in the future. So with that, I think I'm going to wrap up today's video. Thank you all for watching. If you enjoyed the video, please hit that subscribe button. Please hit the like button to like the video. It helps out it helps this channel grow. Helps me out with the YouTube algorithm. So thank you all for watching, and JGraph out.